Welcome back to Real Estate Mindset, you guys. Good morning to you. Happy Wednesday. Today's video is going to be absolutely bonkers. It is a live video. I'm going to try to be fast in this video, and I'm going to try to make this short. It's going to depend on Luke, and if we can have Luke come on, he said he's going to try to make it on this morning, you guys. Luke is with Market Mania. He's got some really, really good perspective. So if he does come on, we'll do some Q&As with him, but I want to keep this really, really, specific to what's going on in the market. So we're going to take a quick market review, see what's going on with interest rates, assets, the inversion. We'll take a look at all of that type of stuff because one thing is for sure, what we're seeing as far as the numbers, and I'm just talking about the numbers, the economy appears to be incredibly strong. Right, from all of the numbers, that's what it appears to be. But what I'm thinking, guys, is the more time that goes on and the more that I'm looking at these numbers, the more I ask myself, I mean, seriously, how much longer is this sustainable? And would people be talking about such a strong economy if it wasn't for the $400 billion bank bailout in March? And if you really think about that, I mean, seriously, guys, stop a minute and think about that. If they wouldn't have injected that $400 billion back into our economy like that, think of where we would be at today. The fear would have probably spread around the world. Unemployment would have skyrocketed. The fear of missing out from the sellers would have ballooned as well. Property values would continue to plummet in some, not all metro areas. I mean, think about it. And then not only that, the credit restrictions, the credit tightening would be so much worse right now if they would not have injected that money. I mean, and be realistic, you guys, and I think about this all the time because I'm trying to buy a house for myself, my family. I'm also care about what I'm saying to you. But, um, you know, if the economy was so good, there would have been no need for a $400 billion bailout, and credit tightening would have been so much worse than what it is right now. This is just such a crazy, crazy time. I mean, the reality is pretty much everyone knows we're in an everything asset bubble. And then why hasn't it popped? Well, a few reasons, but it all has to come down to money because there's so much money that is in our economy and then also being pumped into our economy, regardless of the quantitative tightening that's going on right now. But we'll look at that here in a minute. I'm going to show you guys the updated quantitative tightening. I'll show you guys the updated inversion. But real quick, let me say good morning, you guys. I was trying to keep this fast, so I'm already rambling. But Earl, I just wanted to say good morning to you guys. I hope everyone had a great 4th of July. Everyone hopefully stayed safe. Good morning to you as well. Frenchie, Letitia, good morning. Nightcry, I always appreciate you, man. Good morning. Kim, good morning. Love you, brother. Always love hearing from you. Vital Signs, I love you, man. I'm sorry you're so stressed right now, dude. I'm doing the best I can. Let's see here. Good morning, sir. I hear you on this. Higher interest rates. So let me ask you, Bluebird, do you think the interest rates would have been high enough if we didn't have the bailout? Because they may have been high enough again without the bailout, but I'll agree with you right now. It doesn't appear that the interest rates, at least for the spring home buying season, were high enough, right? All right, let's keep going here. Good morning to everyone. There's my man, Johnny. Appreciate you, Donnie. Don't move. Really appreciate you. Don't move. Really appreciate all you guys. Good morning. I'm going to get started here, you guys. I just wanted to acknowledge that I appreciate everyone so much for joining me. AJ, good morning. My man, Edmund, it's nice to say out loud, Edmund, I appreciate you. Let's get bonkers. Edmund, I see you every video, man. And then my man, Jeff, I'm just going to be real, bro. I was thinking about you all last night, man. Pretty stressed out. I'm like, should I just call Jeff right now and tell him that I'm worried about him? No, I'm not going to do that. Because the thing is I don't want to stand in front of someone's way when they're going after their dream. I'm not going to be that guy that's going to stand in front of people. But, as Jeff's friend, and I'll tell you guys, I talked to him for what, Jeff, like 45 minutes just to make sure you were ready for this. And the thing with Jeff is, because I got some comments, good morning, AJ, he's like, even if it goes down, home values go down in his area, 10, 15%, he's like, Travis, I'm still okay with that. So that's why I'm not calling you, Jeff, all worried in the middle of the night, just so you know that, brother. And then he's not getting a loan. We'll see the damage of interest rates here in a minute. Good morning, Griffin. MFH. Something odd is on the way. Yes. Good morning, history person. Jackie, Wally. Good morning, Scarlett. Okay, I'm going to get started here. Good morning, everyone. I'm going to get started here real quick, okay? All right, and then I'm going to be looking out for Luke, but what we're going to, oh, real quick, you guys do me a favor, like this video, subscribe if you haven't already. Something's going on with YouTube. People aren't even getting my notifications if you're notified to my channel. So if you guys can, please help me do something about that. Share and comment more than you do normally, if you don't mind. But we're going to get started with interest rates right now. Let me kind of cue this up for you guys. We're going to start with the 10-year, you guys, and I'm going to put a timestamp for the market update right now. Okay, so we're going to do our market update right now, starting with the 10-year Treasury, which tracks 30-year fixed rate mortgages. You guys can see that we are starting the morning up with the 10-year going up. So that's a good thing because, again, it doesn't appear that, at least for this time frame, it doesn't appear the interest rates were high enough. And I'm talking about residential mortgage rates, not the federal funds rate, although that's probably not high enough as well, but specifically residential mortgage rates, which what we watch to monitor the 30-year fixed rate mortgages is the 10-year Treasury. Again, it's up almost 3 basis points this morning. That has been the 10-year, you guys, has been going up. So usually what I have noticed is anytime we have something favorable happen in the economy, or like there's good news, or like the revision for Q1 GDP, this goes up. So when the economy is doing good, generally what I see is that 10-year goes up. And as a result of that 10-year going up, we go to our mortgage rates now. Here is our updated mortgage rates. Let's see if they updated it today. More than likely, you guys, this is going to be I would say decently higher by the end of today. Last time it was updated was on Monday. It was a half day on Monday. Obviously, then we had the 4th of July. But interest rates are sitting at, again, over 7%. And this is my point that I was trying to make. The interest rates, as far as mortgage rates, they should have stayed over 7% this entire time. But unfortunately, they didn't do that. And people obviously continue to buy even in the face of unaffordability. But I also think it's really interesting that a lot of people, I think around 9% of buyers right now, are getting their down payment from their parents. So again, I say, is the consumer really that strong, or is there just a lot of money out there? We know there's a lot of debt. But anyways, guys, that's sitting at 7.03%. I'm going to show you here, really the harm on that. So if you guys buy right now, just be aware of how much interest you're going to pay exactly. Now, I've set this up. This is a really cool tool. This is by the Consumer Financial Protection Bureau, or CFPB, which is like the sheriff of the housing market. Had a lot of faith in the CFPB, but anyways, it is what it is. But anyways, you guys can come here. Great place to go if you want to see how much interest you're going to pay. So I just want to show you guys how I teed this up. I'm using a home value of $350,000, and I'm only putting a 5% down payment. All right. And I'm using a 7.5% interest rate. So I just wanted to point out, in the first 5 years of paying that loan with the 7.5% interest rate, here's how much money you waste in rent. Oh, not rent. I'm so sorry. I mean, just interest. You would actually be paying and wasting less money in rent, because literally, and not everyone, but almost every metro area, it is substantially cheaper to rent than it is to buy. So if you have and again, Jeff didn't get a loan, you guys. So this is not to you, Jeff, if anyone thinks this is to Jeff. But if you guys decide to buy and get a loan, so be it. You guys know my opinions. I don't want to stand in your way. I do want to provide my perspective in the data, but you will be paying a substantial amount. You'll be paying 1/3. Listen to me. You're going to be paying more than 1/3 of your actual loan amount into just interest in only 5 years. Think about it. 1/3 of your loan amount is the total amount of interest you pay in 5 years. So go out and go buy a house right now. The economy is hot. Home values are only going to go up. Or what's going to happen is things are going to become crumbling apart, because this isn't sustainable. This isn't sustainable. People can't afford this, you guys, because if anything changes in their life, especially on a fixed income, it's going to be really bad. And I'm talking off of my personal experiences. Okay, I want you guys to understand that I did have a foreclosure, bankruptcy, and repo myself in 2009, and that was no one's fault but my own. Just to be clear about that, all the warning signs were there. I chose to ignore them. Okay, and you know what's really amazing, y'all, is like it's like almost people are saying the almost exact same thing, like just the attitude and the reckless optimism. It's just so shocking to me. It's just almost like, I feel like I'm living in the twilight zone, you guys, but I'm being very careful because I know we don't have a lot of supply. Obviously, loan modifications are really strong compared to back then. Also, loan regulations are much stronger. So I want to be very careful with what I'm saying as well because I don't want to give anyone, I don't want anyone um, to make the wrong decision. There's different reasons to buy, especially when it comes to your primary residence. Again, I'm going to keep saying this on my channel. I think the housing market right now is incredibly toxic. And by purchasing real estate right now, I really feel like many people, maybe not all, but most people are going to be shackling themselves to unaffordability for maybe the next decade. And I've been there, you guys. I am from Southern California. I shackled myself to a house payment back then. And the only thing I did was work to pay my mortgage. And that's no life to live. That's the point I'm trying to make. We're going to the CME Fed tracker right now, you guys. This has pretty much stayed about the same. It's gone up slightly this morning. Basically, 88.7% chance or likelihood that the Fed will raise interest rates July 26th, which is good. Hopefully, the 10-year will go up before then, but 88.7%. Now, what I find interesting about the market is that the market seems to be saying, not this time. The market seems to be saying, let's fight the Fed, which is historically a warning sign in itself. And the interesting thing is the market's not really pricing in a second rate hike. I wonder if it's because of greed and over optimism. Do you guys think that it's because of greed and over optimism? Because the Federal Reserve specifically told us 2 more rate hikes. They said 2 more rate hikes. The market's saying, nah, we're going to fight you. This time is different. I don't know. Maybe this time is different. Let me know what you guys think. Is this time different? Well, it's certainly different in the sense that unaffordability is worse, way worse. But look at this, guys. They're not even pricing in a second rate hike. You guys see September's actually gone down to 17%. November was over 30 before. Let's see what it is. So November's still 32.8% chance of a second rate hike. Let's see what December is showing. December went down to 27.7. So the market is saying basically, and who knows where they get this information, but basically, you guys, the market, I hear you, Wolf. I saw your comment right there. I love you, Wolf. Now, the market is basically saying that if there's a second rate hike, which they don't think there's going to be, but if there's a second rate hike, it's according to this market, it will happen in November 1st, I believe it is. Is it November 1st, you guys? Next meeting? I think it's November 1st. I can't remember right now, and that's all right. All right. Offers ever see this is what I love right here. Look at this. Okay. This is my so you guys think that Johnny's trolling, but he's reverse trolling. He's trolling reverse. Anyways, I love Johnny. Johnny's very intelligent. If you guys want some info, don't go to his website because he doesn't have one. Let's see if any other comments here. And I'm going to get to the total assets here of the Federal Reserve. Also waiting for Luke. I really appreciate you guys. If there's any realtors that are watching right now, Wolf, let me talk to you, Wolf, real quick. And also real quick, if there's any realtors out there that are watching this, comment below. Let me know if you notice in your housing markets, like I'm noticing in my housing market, inventory has shot up. Is it still busy in my housing market? Yes, it is still busy, but it appears to be like, I don't know if you've seen this, but over the last week to 2 weeks, it has appeared to decelerate substantially. If you're a realtor, let me know if you see that as well. But Wolf, I hear you, brother. I was thinking about this, you guys, and okay, so Wolf, thank you. Wolf is in the Phoenix area. Wolf went to the new home building communities in Phoenix after I did the boots on the ground video to confirm what I was saying was true. So thank you, Wolf, for doing that. Now, I want to say this, Wolf, because I think about this a lot, and it really has to do with our mental health. And it really hit home because I read an article. It was actually a research paper on the fear of missing out. All right. And the fear of missing. So a huge research paper was done on the fear of missing out. All right. And it went into the damages of fear of missing out, what it can do to you physically, what it can do to you mentally, what it could do to you if you're a student, what it does to you at work, what it does to you in your marriage. The fear of missing out is so bad. So Wolf, I just want to say this, brother. And I had to check myself because I get emotional about this as well, because I'm really frustrated with what's happening right now. So I can't give personalized financial advice, so I'll talk about myself. I need to remember, and often I need to remind myself that I should be proud of myself, that I should feel empowered because I'm choosing to make sacrifices right now in an attempt. I haven't won yet, but in an attempt to get ahead. I'm making sacrifices. You guys know that I'm renting right now. Even though I own a house, I'm renting right now. I have downgraded my living situation. This house is almost half the size. It feels like half the size of my last house. It's a lot, it's a lot more difficult to sleep. So, Wolf, you should be proud of yourself. I can buy right now, you guys. I'm qualified. I've already went through loan approval. My credit is really good. My mortgage payment would be super low compared to what my income is. I could buy right now. I could literally buy a house and close in 3 weeks, but I'm choosing not to. And I have to, again, I'm just saying this. We should get confidence from our sacrifices. Okay. So, Wolf, if you're struggling right now emotionally because you're frustrated, just like I am, just remember how proud of you should be about you, because you're not doing what most people are doing, which is using your emotions. Even Jeff should be proud of himself because he didn't use his, well, a little bit because it was his dream house, but he used his tactfulness, right? And that's what I'm trying to tell you, Wolf. And also understand this, Wolf. I had to remind myself of this as well. We are literally going through the hot time of the market. Spring home buying season. Now, I didn't expect spring home buying season to keep pace with the inflation of last year, which is essentially what it has done. But nevertheless, my friend, Wolf, understand you're stressed out during the worst time to stress out. The pendulum is swinging. Of seasonality, that pendulum of seasonality and price decline is swinging. So my only point is if you're stressing, man, get out of your house, go on a walk, do a hobby. I'm doing new stuff. Like I'm doing an ice plunge right now. When I jump into a bath of ice, you guys, it really refocuses me. I just got to sit there and I got to take it and I just let loose. So I like the ice baths. I'm also like cooking more as well. Anyways, that's a little bit embarrassing. Where are you at, Luke? I'm just trying to ramble right now, but let's move on to the next thing, you guys. Right now, I'm going to show you guys the total assets from the Federal Reserve right now. And let's take a look at their quantitative tightening. Oh, I got Luke here. Let me add Luke. I'm going to add Luke here. Luke, what's going on, man?
Hey, how's it going?
I'm good, dude. Your audio is a little hard to hear.
Oh, really? Hold on.
Yeah, turn your audio up a little bit. I'm going to reset this up as well. I'm going to share my screen, and then we're going to ask Luke some questions. I'm going to do it like this. Boom. Okay. All right. So, Luke, I am telling the viewers, I'm going to just have it right here. I'm telling the viewers basically the status on the quantitative tightening and the quantitative tightening, right? Quantitative tightening with the Federal Reserve.
Okay.
So I'm going to throw this up as far as a 5. I'm going to go 1 year. Now, for the first time, since, let's see here. So for the first time since September of 2021, basically the quantitative easing right now, as far as the balance sheet, you guys, is sitting at 8.3 trillion. I believe that's 8.3 trillion. The last time we were this low was September of 2021. All right. So we finally started back going under where we were in March when they did the quantitative easing. You guys can see here, and this is what I'm blaming a lot of the resurgence of this hot market is this huge bailout right here. This was about a $400 billion bailout. Obviously, that's going to seep into the entire economy. And then they slowly started doing quantitative tightening again. And as of last week, I wanted to give you guys the good news. We are now under again where we were at March 8th. And if we look at the 5-year chart, we can see us from a quantitative tightening standpoint. Again, like I said, we're at about September, right around here. So cool. So we round the clock from a, money printing standpoint back to September 1st of 2021. I'm still disappointed, Luke. We should have been so much further than this. And let me show this real quick, Luke.
Yeah.
I'm going to show you guys the 2-year and the 10-year inversion because this is changing and I wanted to stay on top of this. Let's see if it's updated. No, it hasn't updated. So I'm going to pull the 1 year real quick. Now we have, as of, I think it was July 5th. So like today, okay? So today, you guys, is the 1 year anniversary. Today is the 1 year anniversary of the inversion, the 2 and the 10-year inversion. Congratulations, Luke. Happy birthday, horrible economy and warning signs. Happy birthday. You've been around for a year. As of today. Man. So we have been inverted for a year as of today. And I also want to make a point that we are at the deepest inversion. Okay. So the inversion right now, Luke, is 108 basis points. Okay, so
Wow.
1.08 basis points. The last time I had to go like back to the maximum graph right now. Okay, the last time we had this level of inversion was in the 1980s when we were in recession. So we have never been this inverted. Actually, from the 1980s on, right? From the early 1980s on. So again, just so everyone knows, and we're going to look at GDP in the 1980s right now, so we could see what was going on in the 1980s. But you guys, we have the same depth of inversion as we did in the early, not the late or mid, the early 1980s. And we've been inverted for a year. This is a huge economic warning sign. Oh my God. All right, but take a look at this. Okay, let's look at the GDP. Okay, so again, you guys, 1980, that's when we had that huge inversion. Look at that. 200 basis point inversion in the 1980s. Let's look at the GDP in the 1980s. Okay, look at this. Because remember, Luke, we have an incredibly hot house or incredibly hot economy right now. So let's look at the year prior to 1980. Okay, so the GDP for 1979, Luke. Oh man, I wanted to zoom in on this a little bit so people could see. Okay, so look at that. This is the GDP right before the recession. 3.17%. The economy was hot.
Yeah,
You guys, the economy was right before all hell broke loose. Are you guys kidding me? 3.17% GDP. And then look at, and then the 1980s hit, and this is a yearly GDP, Luke. We hit negative 0.26, and then look at, oh, everything's okay again. Look at the GDP for 1981. It's 2.54. So it's like, look, everyone's like, everything's okay, hurrah, hurrah, right? And then like, nah, we were wrong. We have to rug pull you again. And then look at the GDP for 1982, negative 1.8%. So really, what I'm trying to tell people, Luke, is like, snap your fingers, things can change.
Yeah.
Right? Snap your fingers, things can change. They did it in the 1980s. And when we look at that inflation battle, we can see incredibly strong economy followed by the negative GDP. And again, positive GDP followed by a negative GDP.
Yeah.
Thought that was really interesting.
And don't get too hung up on the GDP numbers either, because they're deflated with the CPI, which we know is just completely wrong. So have you seen the Shadow Stats GDP numbers?
I have not seen. I'm trying to talk real quick. I was turning up your volume.
Yeah. So have you seen the Shadow Stats GDP numbers? So they basically adjust it for more realistic inflation number, and it shows that last time I checked, the US isn't even out of a recession from 2020.
Because of the way they're changing their calculations. I mean, it's crazy, man.
Well, it's
even CPI. Look, why do you think they keep changing the way they're calculating numbers?
Oh man, you shouldn't start me off on this. This will get me ignited. But the thing really is, I believe this is one of the most important challenges of our time, actually, because the CPI that is being changed every year is basically understating inflation, and that is the thing that erodes the middle class. I mean, you've got to remember, like, the BLS is the one producing the CPI data, the government essentially, and the Federal Reserve makes decisions based off that data. Like, they can't make up their own inflation data and then go off that. So even if they believe it's completely false and incorrect, that's what they base monetary policy on. And this is the same in Canada, it's the same in the UK, it's the same in the most of the Western countries as well. So you've got these inflation numbers that are incredibly misleading. I mean, Travis, like, if we're trying to measure a basket of goods going back to 2000 and like you're taking out pieces of out of that basket every single year, swapping it for different things, how can we then say historically we can look at this data and it's accurate? I mean, it changes every year. It's complete rubbish. And before 2000, because that was really when the corruption of the CPI really went parabolic. Before 2001, the CPI in 50 years changed 3 times. And since 2001, it's changed like 22 times, which is just insane. So, and I think because people don't understand what's really going on with that nobody's going to protest it. You do have to have a bit of knowledge to really realize what's going on. But wages are so negative, man. It's just
That was my next question, man. I mean, they're literally comparing bananas to apples. When you change the when you
Exactly.
change the calculate when you change the calculations, like the math formulas, even the algorithms to come up with certain data sets, I mean, it's no longer going to be accurate as compared to how we did things in the past. So I ask myself that all the time, Luke. I'm like, man, why do people just not say anything about it? I mean, they're clearly
Mm.
I mean, to me, that is the definition of manipulating the data. So like, it's just so disappointing, man, that more people don't speak up about this. Why do you think that normal people don't speak up? Is it because you don't think they understand how this is working?
I think it's a little bit of that, and people, people are so tuned out of reality right now. Like, just go walk around, and everybody's on their phone. People are locked into Instagram Reels, TikTok, all these different things, and they're all just big distractions. Like, even a lot of the news is just distracting stuff, and the actual meaningful stuff, like the CPI, it isn't discussed. I mean, Travis, think about it. If they did measure the CPI like they did in the 1980s, would have we had 0% interest rates from 2008 to pretty much 2020? No. I mean, even though interest rates went up a little bit, they did not go up nearly enough. And inflation
Yeah.
was like around 10% every year after 2008. So when you think about how they're raising interest rates right now because of inflation, just think about it. If inflation was actually 10% for the past 10 years, what they would have done. Obviously, we wouldn't have all these bubbles that we have right now. But I think it's just there's a lot of corporate interests in these bubbles because if you can borrow at 0% or practically 0%, then it consolidates business. So essentially, what we've seen in most Western countries is monopolies forming. And that just creates more money to go and corrupt the government even more. And I believe this is one of the biggest challenges of our time. And I'm actually reading a book about the fall of Rome right now. And it's just crazy to see the parallels between what's happening in like what I would call the Western Kingdom, which is the United States and NATO and all those countries, compared to what happened in Rome. It's very, very similar, actually.
Couple things, Luke. First of all, man, thanks for spending your time with us this morning, dude. I know
No
that you're busy, so
problem.
I can't believe you joined us, man. I appreciate it. Couple things, man. I want to touch on real quick. Now, the first thing is Angelina. Basically, she's thinking of re-signing her lease. She's looking at paying 60% of her income to buy a house here. So, I just wanted to say this, Luke, real quick, to anyone that's watching, trying to decide whether or not they should extend their lease. It's that's really, first of all, let me say this. It's really, that's an answer that you have to, basically, that's a question you have to answer yourself. Hopefully we provide the data perspective to help you answer that. But what I did, Luke, is I decided to, man, and it hurt, I decided to renew my lease to December of this year, and honestly I'll probably try to renew it another 6 months. And I should be proud of myself for doing that. I easily get distracted with like the fear of missing out, right? But
Hmm.
I notice that sometimes I got to take a step back and say, no, Travis, remember, right? Remember what your goals are. Remember what you're sacrificing. Take your time. This is a big transaction. So I definitely think that, and I was hoping to purchase February this year, and I tried, Luke. I put in an offer. I tried. But I mean, I think that people really need to take a close look at renewing their lease versus jumping into purchasing. Now, I want to show this, Luke, real quick, sticking with the income thing. Take a look at this. So, this is from Scarlett. She's basically saying I'm not spending more than 25% of my gross income. I would, if she would have said net, I'd have been like, girl, net, yeah. But it's cool. It's cool. Gross is cool too. 25% of my gross income towards my mortgage. I refuse to be house poor. I need money to keep my hair. I didn't see that last part, Scarlett. Scarlett, no, no, Scarlett, save your money. Don't get your nails and hair done. Um, but can you go into, how important it is not to spend all of your money on your mortgage, and what do you think might happen, Luke, that now that unaffordability is so bad? And keep in mind, like, some of these assessed property taxes haven't even kicked in, school loans, insurance. Do you think it's good to use 25% of your income only to pay your mortgage?
Yeah, I mean, you want to keep the number as low as possible. With the inversion of the yield curve and the predictability in that, you know pretty much factually that the economy is going to be heading into a worse state. So if the economy is going sour, who knows what that means for anybody's job, including mine, including yours. So you want to keep your expenses as low as possible. And that's the best thing to do heading into a bad economy, because we really don't know how bad things are going to get, right? And that's why I probably think it was a good thing, Travis, that in February that offer didn't get accepted or what, because we don't know what's going to happen, right? At least after the yield curve uninverts and when the recession crisis hits, you can then make an educated guess on what's going to happen based off the data. But right now, we have no idea what that's going to be. So, it's saying it's going to be something pretty catastrophic.
So here's an interesting question. I know this is a little bit naive of me to ask, but hopefully it starts a good conversation. So, Luke, when does all of this stop, and when do we go back to normal?
Well, have we even been normal? I mean, the pain has just been getting worse since 2008. I mean, all that happened after 2008 was they put band-aids over the problem and they said, okay, let's just create bubbles everywhere else. And now we're sat in the everything bubble. So I think the pain really stops when we really start to see this mean revert in terms of credit. There's been far, far too much credit that has been created and gone into these asset bubbles, far too much malinvestment. And I think that's when the pain stops. But I really don't think that's going to happen. I think even though we're going to see a potential crisis in the future, I think you're still going to see the Federal Reserve and the federal governments trying to print their way out of this, as they've done for the past 2-3 years. I mean, it's really my hope that they don't do that, but I just think it's inevitable because they're always trying to buy votes and the masses just can't deal with even a little bit of pain. What do you think of that?
Well, I have a lot of feelings about that, Luke. Um, so the thing is, man, my first thought is well, if they continue to print money and continue to prop things up, it's just going to add to the bubble. Things are just going to continue to get worse. They have demonstrated the QE, obviously the quantitative easing, but I'll also make the argument, Luke, that the reason that we're in this situation is because of the quantitative easing. And to be honest with you, one of the best things that, in my opinion, that the Federal Reserve can do is step back. Like they should have stepped back with the banking crisis. If they would have stepped back, then the economy, the boom bust part of the economy would have hopefully naturally healed itself and reset. Now, there would have been a tremendous amount of pain. I understand that, but I think the quantitative easing that they're doing and the bailing out, Luke, I just think it's so reckless. I don't think it's targeting the real problems. I think it's just being thrown out in the economy, and it spreads to other areas of the economy. And quite frankly, I think it is possible, but when we look at, does the government help the little people? I mean, they're helping the ultra rich, they're helping the banking system, but it's the little people that are being hurt right now. That's why we see the property tax, hikes. The cities aren't doing anything about it. They're just raising the taxes, for all they do the political dog and pony show, we're going to lower taxes, but when it comes to the fighting and the Senate and all that, it's dead on arrival. I don't think that the government is going to bail out the people. I think the government will bail out. Hopefully they don't, man. But I mean, what can I say? They just did it this year, so I think that they will continue to bail out certain sectors of the ultra rich. But as far as us, I think we're freaking doomed, man. And that's why I think there should be even more caution in the housing market. And I think we're really going to see that with short-term rentals. I think we're going to really see that in short-term rentals. And I say that not because of everyone seeing on YouTube, the losses of revenue. The losses of revenue is a big deal. The vacancies may be a big deal. But what I'm specifically talking about with STRs is the Airbnb bans and the regulations. Like in Dallas, has, I think, 5,000. I can't remember. I think it's 5,000 STR homes. They just banned it. Wow. They changed the zoning laws, dude. That's almost a communist move, bro. Like they shut Airbnb down hard. in
Wow.
Dallas, and that was just done, man. And that's 5,000 units. You know, that accounts for 4% of the total housing inventory in Dallas. Not every
Wow.
metro area is going to react the same way. So I don't think I think the federal government is going to bail out. I really hate to say it, but because when I say that, it just makes me feel like they're so weak, and it just feels so wrong. But I think they will potentially bail out those ultra rich people. But I think when it comes down to it, like always, the people that are going to be paying for it is the American consumer. Everything is being
Hmm.
thrown on, or just a consumer in general. Everything's being thrown on our back. We're the ones that's paying for this. These recent homeowners, Luke, they're the ones that is paying for the money printing. They're paying for it the
Yeah.
most. Anyone that
Yeah.
purchased after, especially after 2022, thank you, because you're paying my stimulus. I mean, do you agree
Hmm.
with me there, Luke?
Yeah, I mean, I think it's kind of crazy with the short-term rentals and everything because that's a bubble in itself. And I kind of get where you're at with it. It is like a doom loop almost that we're in. And I think, I don't know, I just believe we're at the end zone now because when I look around, I think how can they inflate this anymore? People
Yeah.
can't afford anything right now. They can't afford their car, they can't afford their student loan, they can't afford their house. I mean, it's kind of funny because when you go to other countries and you go to countries like Mexico where the average people, they're not in debt, they own their house outright, and then people are rushing from other countries in South America to come to places like United States and Canada. I think what they don't realize is that it's just an illusion of wealth that we have that has
Oh,
been created by the past 20 years of monetary policy because like people don't own anything. Like people don't own the homes, they don't own the cars, they've got a ton of credit card debt. Like it's not realistic that this is going to continue. We can't just keep piling on the debt and our income's just not going up. It doesn't work. So at some point you're going to get to that top. And I think that's where we're at right now because I just do not see how they're going to inflate this without inflating people's incomes, which would cause like a massive amount inflation, and then we'd be right back where we are right now, essentially, with interest rates even higher, possibly. And that might happen. I really hope that doesn't happen. Like they don't do the stimulus route again and everything like that. But I'm not even sure that like as in the stimmy checks itself, like the $1,000, $2,000 checks, I don't think they really had much of an impact. I think it was more of the business supports that were put in
yeah.
place, things like the PPP, the CEWS, it was called in Canada, furlough in the UK. There were all these massive schemes where they were throwing money at businesses, essentially interest free. And some of it, there wasn't even a penalty to pay it back. So, you know, I don't think that it can continually go on this way anymore. I think that it has to stop because at the end of the day, if the person's debt payments are now more than their income, you're running on fumes. How long can that last? I mean, in 2008, it was just mortgages. That was the reason that 2008 got caused this financial bubble. Securities and mortgages,
Mhm.
that's where the bubbles were. But now it's everything. It's loans, it's short-term rentals, it's student debt, it's private business debt. What is not inflated massively and what is not in debt. And now we've got interest rates where they are right now, and people are like, everything's going to be fine. And I'm like, what? Like, how?
And you know what? People want to stay in that comfort bubble. And
Mm,
when all of that stimulus money, through the lockdowns, people got to stay home, not work, and some people got paid more money than even working. The unemployment was higher than their
yeah.
actual wages. Um, our society is a spending society. It's not a saving society. I see it getting worse. I see generationally it's getting worse. So how that knowing that it's getting worse, people are spending less, more debt. Why would people think the consumer is strong enough to support this? I mean, we're looking at buyer's remorse surveys now. I will say, Luke, that one thing that is really, really astonishing, and honestly, I don't necessarily have to be super careful. I don't necessarily think this is a bad thing. Not necessarily, and you got to forgive me, brother. I went through a foreclosure myself. I went through that
Hmm.
heartbreak. I understand the mental turmoil as well, and mental was way worse than the physically losing things. But I totally lost my train of thought, dude. I looked at a comment. I was like, oh, that's a good comment. Did that ever happen to you?
You were yeah, you were talking
It
about
does.
your foreclosure.
You know what I need to do, man? I need to take some of that lion's brain, or what was it called?
Lion's mane. Yeah,
The
it's a
lion's mane.
mushroom supplement. Yeah, it's so good. It's really good. Helps
Yeah.
you multitask.
Anyways, I guess what my point here is it's really astonishing to me the lack of caution. And I think that the
Hmm.
reason that we see a lack of caution is because there's just so many businesses, media outlets, so many people that, I mean, they have a financial bias. They have a
Yeah.
financial bias. They're paid to come up with narratives, and it's all over the media. When we have so many indicators of a red flag, we have buyer's remorse surveys, we have unaffordability charts, we pretty much have history on our side saying recession, and then people like us saying, hey, these numbers are looking better than they are, probably as a result of the money printing, right?
Hmm.
Because, and I keep saying, look, like when you remove the money printing, when we remove the stimulus, the low interest rates, the economy comes crashing down. So that
Yeah.
tells me it is being propped up. There's no doubt about it. Big shout out to Todd. Todd, I got your reports, man. I really appreciate all your stuff, Todd. He's a viewer. So, Luke, let me ask you, man. Um, when do you think we get inventory? Enough inventory to where it makes a positive, long lasting difference?
Yeah, I mean, it's hard to pinpoint it exactly, but it's going to depend on the economy and it's going to depend on unemployment. I think unemployment is going to be significantly higher than it is right now by the end of the year. And as you see unemployment go up, that's when you're going to start to see the forced sales. I mean, we're already seeing all the warning signs about the economy going sour right now. A lot of people are in denial to that, like you said. So I think there is a lag with that because people are in denial. So they'll start to realize it when the unemployment hits them like a slap in the face. And then that's when you're going to start to see the inventory. And then when the Airbnb hosts, to your point about short-term rentals, I mean, look around your local area, look at some of the houses I have, and they've got like zero bookings. So the Airbnb hosts are mostly the demographics are people between 30 and 50. Like that is the age range. So these people are very emotional when it comes to making financial decisions. So that in my opinion, they're going to be the ones that hang on to the bitter end and then end up in foreclosure. So I agree with you on the short-term rentals on that point. But I think that it's going to be probably next year sometime that we start to see the inventory really start to hit the market. You know, Obviously the real estate market is seasonal. Depending on where you are, it might be more extreme than in other places. But you have to think about, well, what is going to force people onto the market? You see a lot of people think about markets in terms of, oh, well, you know, they try and pin it to different things, but when you're in a financial bubble, it's very hard to pin it to different things because the market is detached from fundamentals. That's how you know you're in a bubble, when a market is detached from its fundamentals, which are income for the housing market, interest rates, affordability, all of the things that you've just said. So I think as we see the economy start to worsen, that's when you're going to really see the stuff really starting to hit the fan. And have you checked out, Travis, the Google Trends? I've done it for Canada, but I'd be interested to see what it was in the US too. I think I checked and it was similar. But if you just go on Google Trends and put recession in, you'll see that actually last year there was quite a lot of search activity for that. But this year it's gone down loads. So
Yeah.
the soft landing no narrative, a lot of viewers on our channels probably don't believe that narrative, my guess is, but you have to realize that a lot of people believe that. So you are in the minority, which is where you want to be, in my opinion, because you don't want to be in that majority camp because that's the herd camp. That's the camp that is always being led to slaughter.
Yeah. I pulled this up, man. I have some really good comments I wanted to go over with you. Um, just really appreciate your time, man. I feel like I never get enough of your time. But here's Google Trends right now. Here's the recession.
Yeah,
So what
so
do I?
change it from a day, and put it out
Okay,
to like 12 months or something like that. 5 years,
past
12
five
months.
years. Yeah.
Yeah, look at
Oh
that.
my. Yeah. Yeah. That's crazy to me.
So
Jeez. Okay. So
2022, the housing market was going down, right, and people were worried about a recession. And this year, no fear of a recession anymore. So exactly the same as Canada. Isn't that crazy, Travis, that, doesn't matter what country you're in, you're seeing the same trends?
that is. That's the thing. Look, like that's what I'm really trying to tell people because like last great financial collapse, it was really kind of isolated to the United States, and the world was able to absorb a lot of the pain or buy mortgage-backed securities or treasuries, or whatever. But like this time, it's like a world systemic failure as a result of
Hmm.
the overprinting. So um, it's pretty shocking though, and pretty amazing. Look, watching the entire world try to keep things propped up. I really find
Yeah.
that really astonishing. I have three comments I wanted to go over with you, but real quick, if I may quickly, let me show the viewers the name of your channel. So the name of Luke's channel, for some reason, I can't scroll up, but it's Market Mania. If you guys want to check out Luke, the dude is really awesome. He's pretty much traveling around the world, giving us intel on like STRs and housing markets. So he's really heavy into like seeing what's going on with Airbnb. Luke is an amazing person, very
Thank you.
honest. He does swear sometime on your lives. Don't be swearing on my lives, Luke. um, but I wanted to paint a picture real quick. One of the catalysts for the price growth and kind of why everything got so broken out of fundamentals is because of the migration. I mean, we saw
Hmm.
such a huge migration. I just wanted to go over this real quick, Luke. These are their top 10 metro areas home buyers are moving in and out of. Okay. Number one, oh my gosh, San Bernardino. Okay, this
Wow.
is the number one move to metro area in the United States right now, and I did a video there. Everyone is moving there because they cannot afford to live in Los Angeles or
Right.
Orange County. So, like, that's crazy to me because they also have year over year price decline. Also, look at number two, bro. This one hurt. This one hurt me bad. This one hurt. Houston. Houston's in the number two. That makes me
Sugarland.
sad, dude. That's like, stay out of Houston, guys. Houston's on there. Obviously, Florida all over this list, South Carolina. But Florida is just everywhere. Everyone wanted to move to Florida. Pretty astonishing. Anyways, just a quick plug there. Let me go back to some of these questions. These are such great questions. All right. First, sorry to give you a shout out, Todd. Yeah, exactly. House hacker. Recession or not, we should be saving our money. I'm just saying, it's even more important to save our money because of the recession. It's really hard to save money in a
Exactly.
recession, but we should always be saving our money. Also, did you like this shirt, Luke? I don't get older. Okay, level up.
That is
All right.
great.
That's where I'm from. This is my hood right here. This is what I did. See, when I was a kid, we had a Game Boy, but you had to charge it 8 hours to have a 1 hour playtime. And it was in black and white. Now that people got cell phones, geez, these kids. Anyways, so some good stuff here, man. I starred them. Let me pull this one up first. Let me read this to you. This is pretty sharp. AJ's pretty sharp. I think perhaps the pause, and you talk about the federal funds rate. I think perhaps the pause was strategic. I think it may have worked actually. The realtors were trying to get people in before the next rate hike. This has caused people to think a little bit more. And it's really crazy, Luke, because like, even though from like 6.8 to 7%, it affects your payment like depending on the loan amount, $20, $30. It's like people are
Hmm.
paying attention to that $20, when they're not paying attention to the $1,000 increase. So what do you think? Do you think that looking from the outside in, of course, we don't know what's going on entirely. Do you think that the pause was appropriate?
Um, Yeah, I mean, inflation has come down a hell of a lot, and that is indicative of what is happening in the economy. Obviously, if you've got inflation coming down that fast, you've got to ask, well, why is that happening? And it's going to be because the demand side is being pulled, which is not good for the economy. And all of this stuff is backward looking as well. So yeah, I mean, I've said for quite a while now, in the case of the Bank of Canada and the Federal Reserve, I really don't think it matters anymore whether they go another 25 basis points or 50 basis points. If they just sit and hold here, they're going to crash the economy. And the yield curve is telling us that. So, I think the fact that people are so hung up on 25, 50 basis points, I see a lot of realtors talking about it here on YouTube, is just because simply they're playing on the emotions of the housing market. It's as you said, Travis, like if it's having that little effect on their payment, then why are people talking about it so much? Why are people making such a big deal of it? And it's really just because it's so emotional. The market is so emotional right now. And the only point when we're going to bleed all that emotion out is when people start losing their jobs. And instead of focusing on real estate, they're more focused on, am I going to have my job in 12 months? And then suddenly real estate is out of the window. It's not in the back seat. It's out of the window. They don't even care. Like, who, just put yourself in that position right now. Say you lose your job. Do you really care about what's going on in the housing market anymore?
No.
You don't. And that's probably going to be within a couple of years of that will probably be the perfect time to buy. And everybody will be looking for a job at that point. So when things start to recover, if they start to recover, I mean, that's being optimistic. I hope they do. I really hope they do. So yeah, that's kind of my 2 cents on that.
And my opinion is well, surface value. No, I don't think they should have paused. I think they should have given us more pain to compensate for the 400 billion. I'll just keep going back to the 400 billion. Now, the reality is we don't know if it was a wise thing to do yet. But I love how you said that, Luke. I mean, people are so focused on those little petty things, quarter basis points, 50 basis points, when the reality here is like, if we can sustain this level of tightening of high interest rates, it will crash the market. It will eventually crash the market. And we already know that because it happened in March of this year. It crashed the market, the banking sector, the bank runs. And the interesting thing, that wasn't a result of fraud. That was a result of low interest rates. It was a systemic failure. So anyways, so here's another one. This is good. Really some broad questions here, but I think it's really important to really see what's going on out there, Luke. How can you get a good night's sleep? This is important when you have this housing stress. Best thing you could do is forget about it, direct your attention elsewhere. Can you touch on what you believe the mental health challenges are for many of these home buyers on the sideline waiting for homes to be more affordable?
Yeah, I mean, it's really, really tough. And I think the best thing to do is distract yourself, but don't disconnect completely from it, because I think you still need to be aware and have your hand on the pulse of what's going on. So, because think about it, when I hear about just disconnecting completely, I think of the herd, because that is what the herd is doing right now. They are totally disconnected. They think there's a soft landing, no landing. So, you can't be into this sort of content all the time. It's going to depress you. But you need to have your go-to people like Travis, who you go to, you watch on a regular basis, and you keep updated, and you know and trust that they're providing you the data without financial interest. I mean, as you do probably too, Travis, the first thing I do on YouTube is I'm looking and thinking, is this guy trying to sell me something? Because if he's trying to sell me something, where are his biases? Because then I don't want to watch him. So it's kind of crazy in that way that we have to do that these days, but you do have to do it. And when you think of like the likes of CNBC, they have massive biases and financial interests. That's why they're always constantly wrong. That's why Jim Cramer is always picking the wrong stocks. So, and you have to think these large creators are just an extension, unfortunately, of the mainstream media, because a lot of them may have been really good at one point, but unfortunately, once they see these massive promotion deals coming in, they just can't look away from that money. So you have to just be aware. And yeah, I think it's important, mental health. I mean, it's kind of crazy because you and I, we talk about this stuff a lot, and obviously we go through it on our YouTube channels as well. And then I try and distance myself from it the rest of the time, because I try and distract myself. I do listen to other people and other content, but I limit myself to like an hour or two a day. I don't go crazy. And I think you have to set those limits, because we live in this such digital environment now where it's too easy. It's way too easy to just sit there for 10 hours just listening to stuff on the economy that is not going to make you happier.
Yeah, and dude, I've lost sleep. Usually, I lose sleep for different reasons, but just to go into what Ben Savage is bringing up here, and this is incredibly important. I'm working on a video right now, Luke, where I'm going into the actual like research, clinical research on the fear of missing out, and again, the negative effects that does, and it's like the fear of missing out is like it's way worse than what people are realizing, and then a lot of people don't accept that they have the fear of missing out. So the thing that I would say, anyone that's struggling, you gotta find a hobby. You gotta get your mindset thinking about someone else, whether it be serving other people. Like if you're stressed, like think of someone else. Think of taking care of your spouse, someone else. Think of someone else, or do a hobby. What I had to start doing, Luke, I start doing ice baths, man. You see some of the pictures Ivy sending in our group chats. I mean, that's what works for me for some reason.
It is really good.
It's so good, man. But it is stressful out there, and I think people need to understand. That's why I'm raising my voice as well. It's just like, you guys, like, better be stressed than financially ruined, because then if you're financially ruined, you're also stressed anyway. So at least you still have your money, Ben. You know what I'm saying, dude? At least you're still mobile. At least you're still free. At least you're sacrificing. At least you're working on your goals, and you should be proud of that. And don't forget that. And that's my point there.
Well
Let me
said.
see if there's. Go ahead. Sorry, look what we're saying.
I just said well said, what you said
Thank
there.
you. I'm going to go to the bottom here of these comments. I got was taken back a little bit by all these comments. I mean, people are out there struggling, man. And people really underestimate that mental health aspect of everything, and how
Yeah.
much that could really hurt us in a lot of ways.
Yeah.
So let me see here. 50%. Okay, I'm at the bottom here. Let's see. Let me ask you this, man. Do you think that there will be unemployment this year? And if so, why and how?
Yeah, I mean, I think if you even look at the difference between the establishment survey and the household survey for unemployment, it's already showing that unemployment is starting to trend upwards, and we're seeing jobless claims start to creep up as well. So I think unemployment, yeah, it's definitely going to rise. It's just a matter of time. In fact, the ISM manufacturing report that just came out, you may not know this, Travis, but a lot of the CEOs that were interviewed in that report were saying that they were holding off cutting jobs because they thought that the second half of the year was going to be better. In what world is the second half of the year going to be better? Me and you know that, but these CEOs, unfortunately, they just believe the central planners, the Federal Reserve, the politicians, CNBC. I mean, it's unfortunate. It's the way it is. I mean, when I went in and visited a brokerage in London, when I was back, I went there for this thing. So I went to this prestigious brokerage in London. They all have Bloomberg on. Like, Bloomberg is on everywhere. And I'm thinking, Bloomberg is the mainstream media. like you've got all these financial traders that are trading like millions and millions of dollars, and they're all listening to Bloomberg News. And it's just like, okay, yeah, mainstream media.
So this is the unemployment rate from Fred. I mean, obviously, you know that. It's going to update any day now. But I wanted to point out, let me go to the year real quick, and I want to show you, Luke, because this is like so crazy to me. Let me go back to when we started quantitative tightening. Come on. What the heck? So anyway, so quantitative tightening was right here. So quantitative tightening, March 2022. This was when the Federal Reserve was like, all right, we're coming after the labor market, blah, 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 blah. Unemployment was 3.6%. So after what, over a year, not a year and a half, but over a year, they've only got unemployment from 3.6 to 3.7. And then also what's interesting is if we look at the 5-year mark, we can see that actually, surprisingly, look, we're actually above unemployment, or at the same unemployment as pre-pandemic. If we look at the last 5 years, and if we look before the pandemic, we could see the unemployment rate was sitting at 3.5 going up to 4%. So the highest unemployment got to in the last 5 years was 4%. So you add, so
Mhm.
it's been strong. So the labor market's been strong. So when you add the PPP, you add the EIDL loans and all of that money through COVID, I mean, it's even stronger. And we know that because the quantitative tightening is essentially has done almost nothing to the labor market, even though the trends are reversing. But this is really just really really crazy to me, man. I mean, did you think that the unemployment rate was going to go, because it did go down partially through the quantitative tightening? Did you think unemployment was actually going to go down through the quantitative tightening?
No, to be honest, I didn't think that the unemployment was going to go down, but then like there is a massive lag effect to all these
Yeah.
interest rate hikes, and that's the kind of thing that I wasn't taking into account. But yeah, it's kind of crazy, you know, and as you showed in that chart, look how fast it went up during 2020. So that is possible. And just think about it, the yield curve is predicting
Yeah.
something worse than that, Travis. So like what does that mean? And look how fast historically like it's risen. Like when it rises and it gets going, it is freaking fast.
Yeah. I mean, like if you look, okay, so they February unemployment was, and I know this was during the lockdown, so this is a very extreme case, but
Hmm.
from
Yeah.
February it went from 3.5, and then 2 months later, Luke, 14.7%. Are you kidding me? So it went up what, 11%
Hmm.
in 2 months. And that's why I started out this video, man. I'm like, things can change like this, a snap of the fingers. That's why we showed them, like, look at the GDP in the 1980s. Like in 1979, GDP in 1979 was 3.17. And then recession hit, and then they thought it was okay again. And then another recession hit. It's like, come on, guys, we've learned these lessons before, right? But look at but the labor market appears to be propping up the economy, does it not?
Yeah, I mean it appears to be, but yeah, it's not gonna last. We know it's not gonna last. Like that's the thing which makes me laugh is the central planners point to that and they say, okay, this is the thing we're gonna follow the most closely, like the thing that lags far, far behind. I mean, US already had two negative quarters of GDP last year. And like everyone was like, "Oh yeah, that's fine." And now it's like, "Oh, everything's recovered. It's booming. Interest rates have gone even higher since then." But somehow everything's miraculously fixed itself. Are we really meant to believe that?
I,
And the
I know what the
banking
fixed
crisis.
I know what the fix looks like, Luke. I have it right here. Look at. Let me show you what the fix looks like. All right. Here's the fix right here. Money printing. Here, this is the fix. This is the blueprint on how to fix the economy from the government. Now look at this. So wow, look at this. Look, we don't even talk about the quantitative easing here. We don't talk about this, Luke. Look at how much money they pump back in. That's
Yeah,
crazy. 3 trillion, is it? 3 trillion. So I
it's
mean, come
it's
on, guys.
nuts. I
This
think
is
the
their
main
solution.
thing I think the main thing, though, it wasn't even the quantitative easing that did cause part of it, but it was the government spending. Because think about it, all quantitative easing is, in simple terms, is just bank reserves being given to the banking system. But it's up to them whether they go out and lend based off those new reserves. And if you think about what's happened with the quantitative tightening that we've seen, do you think they're going to be more likely or less likely to go and lend out after what has happened, even if there's little bursts where they're bailing out different things? I think really the thing that saved the economy, saved the day, and it only did it temporarily, was just the CARES Act, the insane amount of
Mhm.
government stimulus, the PPP loans, those were all the things that propped it up because then the banks said, okay, well, everybody's getting free money. So, of course, we're going to lend. Of course, we're going to lend. So now it really becomes the question, are they going to do that again? I really struggle to believe that. I mean, what do you think? I struggle to think that they're going to do it again, given where inflation is, but who knows?
So I asked myself, look, the first thing that comes to mind depends who's elected, and then I asked
Hmm.
myself this question though. Okay, so I keep that same line of thought. Will it be worse or better with a Republican? And seriously, think about it. Think about it. I don't know, to be honest with you.
It'll be the same. I mean, look
That's
at Trump and Biden. They did exactly the same thing, pretty much.
I mean, man. I mean, to be honest with you, I think things have to break. I think things
Yeah.
have to break because it is so far from fundamentals that the normal, everyday American potential homeowner specifically is just they're dead in the water, man. I mean, people can't
Mm.
afford. People, a lot of people, some can, yes, but many people can't afford these prices of insurance. I mean, how is the economy good? How is the consumer strong when they can't even start school loans? And you know, maybe not everyone watching knows this, but you and I know that school loans is one of the, I have to be careful, best debts to be in. And let me be specific. I'm not saying debt is a good thing. I'm just saying when we compare school loan debt to something like credit cards or even car loans, school loan debt is one of the easiest debt to renegotiate and to come up with payments. You can literally call them and say, "Hey, I don't have money. I lost my job or whatever," and they will stop your payments. So school loan debt, again, is one of the easiest debts to manage in that way. Obviously, it's a tremendous amount of debt. You can't even go bankrupt on government school loans, so the debt follows you for the rest of your life. But my point is one of the easiest debts to manage. They can't start it. It's freaking crazy to me, man. I mean, these narratives, when we take out the level of quantitative easing, and when we take out, how the government is just kicking the can down the road. I mean, we all know everything would fall apart right now. So again,
Yeah.
like you said, the question is how much more money printing will be going on here, and that's hard to answer.
Yeah, I mean, that really is the thing. I mean, if they do this again, I think because the inflation is really the end zone, as I think about it, with the fact that people just, this can't continue any longer. So I think if this happens again and you see more inflation and even higher interest rates, then I think that's the end game right there. But this could be a cycle that plays out over the next 4 or 5 years. That's the unfortunate thing about it, that we don't know. We don't know how long this is going to play out for. And yeah, I mean, we were talking about the lockdowns and how unemployment shot up. Well, imagine your bank account froze. Everybody's bank account froze. How quick would unemployment go up? It would probably be even higher than it was during 2020. But those are some of the scenarios that I'm thinking through, because I'm like, man, the yield curve is never wrong, and like it's predicting way worse than 2020, way worse than 2008. And 2020 wasn't even really a financial system shock. It was really a pandemic, and it was a response to a pandemic. So it was kind of totally different in that respect, because back in 2008, as you know, like if you wanted to go get a home loan in 2009, 2010, even in 2012, dude, 4 years later, we were trying to get a home loan in the UK for an investment property. Like, they did not want to deal with you. So that is what freezes up the housing market right there. So even though you can have a ton of buyers who want to buy, and they cannot buy because they're like, nah, we don't want to deal with you. We don't want to get involved. We don't want to lend to you. Especially if people are saying, yeah, we want to do Airbnb. They're going to be like, no way. I'm not touching that with a 10-foot pole. And a lot of the Airbnb stuff has been financed through private equity. Like these even more risky loans that are like 9, 10%. So it's just kind of baffling. So imagine those aren't chartered financial institutions. They don't have access to the funds that JP Morgan has. They have to actually get funds from the market. People have to be willing to give them the money to then them go lend it out to somebody else. So you're going to see a massive, massive credit tightening in that area. In fact, that's already happening, because probably happening in the US too, but here in Canada right now, a lot of people want to get their money out of those private equity firms. They don't want their money lent out anymore, and they're battling to get it back because the private equity companies are like, we already lent the money out, so you got to wait. So we're freezing your withdrawal. So what does that say? And who knows? Those people could be in distress too, Travis. We have no idea. They could want that money because they're in distress. Like, I think you and I know that people, they don't have savings, and we're running on fumes right now. And what shocks me the most is that people are out there right now in denial, willing to make the biggest purchase of their life, highest prices and highest interest rates. It's baffling to me.
It's a psychology, man. I mean, that psychology
Hmm.
is really the social norms. You like, just speaking of myself, to be a man of my house, I have to buy a house. There's a lot of emotional turmoil. But look, I can't help but feel, and I got to be careful because I know we had a conversation with Todd this morning about Airbnbs. It's pretty funny. But do you think that there's a problem with, and we'll touch on institutional investors, and I'm going to bring up something while you're answering this. But do you think there's a problem with institutional investing or investing in the housing market right now? Do you think that's a problem, and how much of a problem do you think it is?
I had to think then because I nearly swore. So I'm glad I didn't swear. But yeah, it's a big, big problem. It's a massive problem because it's malinvestment. This money should not be going into the housing market. This is driving productivity down because if you've got money going into the housing market, institutional money that's bidding up the prices of homes and different things like that, then that is just going to affect the normal people that want to buy that home. They're going to be even more shut out of that market. Their productivity goes down because, and the way I see it for young people right now is they have no incentive to work. And that is why productivity is like crashing because they have no incentive to work because they're like, I'm never going to be able to afford a home. I'm never going to be able to afford this. So the more that happens, the worse things get in the real economy, in my opinion. And I just think that that money would be more productive if it was being lent out to small businesses, if it was helped going to small businesses or encouraging people to start up small businesses, because that's what we need. The problem that people don't understand is that actually the problem that we faced over the past 10 years is the fact that these large corporations have had unlimited access to capital through the credit markets at practically 0% or much less than a small business. And it's not a level playing field. It's not fair at all. I mean, yes, the small business should be paying a little bit more interest rates because they are more riskier as a borrower. But at the end of the day, it shouldn't be like this huge margin between the two. There shouldn't be this huge gap that is between the two because that just makes an unfair advantage for these companies, and which has led to so much consolidation of different businesses.
I don't know what happened to my screen share. I want to show you something, Luke, that is really astonishing. So, Amazon. Okay, Jeff Bezos, is that how you pronounce his last name? Is it
Bezos.
Bezos. So he made a institutional investing company. I don't know if you've heard. Let me stop screen sharing real quick. And I just wanted to show like how, in my opinion, Luke, I think that institutional investing is just shockingly bad for the housing market. The way they're investing, let me show you the way that people are investing right now. Like, if someone wanted to invest in real estate, look at what these people are doing, Luke. So, this has been Zynga. Okay, this has been Zynga.com. You think the guy's got an ego? I mean, seriously, this guy's got a huge ego. He's named his website after his last name. Maybe I should change the name of my channel to Spencer Mindset. Do you think that I should have that much ego? But look at this. Look at what this man created, dude. This is freaking crazy. I have a separate video on this. You can become a homeowner and invest for $100 freaking. The historical returns on this platform is 9 to 13%. I can look at all these houses they want to make an offering on. Minimum invested $1,000. Offer 233. Luke, I could just hit a button, bro. And then they're going to go buy a
Wow.
house from someone that would have probably purchased a house that was an affordable house. And they're buying new houses too. Look at this, dude. And so when I click it, it tells me 86% funded. So they have 255 investors now that want to purchase this house. They're not even living there. They're just putting their money. So the more that people are putting money into things like this, man, I mean, it's just so bad. I mean, they make it so easy to take houses now. Isn't
Hmm.
this not? I mean, this is just so shocking to me, man. I mean, you could go into this. I mean, but
I think it is really bad. I mean, I think the zoning laws really have to be amended or changed to reflect the fact that there is so much institutional interest in housing. Like maybe, I don't know, that they can only buy, or businesses or corporations, massive corporations can only buy in certain areas, or they can only buy new construction, so it doesn't impact supply as much and encourages new development. But something has to change. I mean, the kind of positive thing, I suppose, that you could look at, or the thing that might be good, is the fact that this did happen in 2008. It didn't happen on this level where you could just have an average Joe or Jane just go in there and, put in $1,000 essentially in crowdfund. But you had like bigger investors that were doing the same thing, and pension funds that were doing the same thing. And it was just because housing was the hot thing. But what happens when housing becomes the opposite of the hot thing? I had to stop myself swearing there as well. The garbage thing. What happens when housing is flaming garbage? You're not going to have any people want to invest in it. And that's really the main thing that you can kind of look at and say, well, that's a little bit optimistic, but I think that will hold true at the end of the day.
Yeah, I don't like crowdfunding, man. I mean, they've got so good at this, Luke, that I mean, I could literally, if I want to invest in vacation rentals, they have a whole category of homes that
Wow.
we can invest in. Vacation rentals. They have single family residence categorized. Look at this. They have rented out already if you want to make sure it's already rented. They have newly built. I mean, these guys are coming trying to get money from everyone to go buy these houses. I mean, the crowdfunding, you man, the institution. I mean, it's a problem.
Wow. Yeah,
It's a
it
problem.
is.
But I was shocked how easy it was, and how appealing that they made that website to invest in this way. I mean, it's really sad because again, it's like most people, they don't care about the investment aspect, Luke, of purchasing a home. Most people, they're buying their primary residence, roof over your head, right, and that's
Hmm.
it. And that's what we want. So what happens is you get a couple of these really really clever people like Grant Cardone and these other people. They put together this hustle, and it may have worked for maybe even a decade, maybe it worked for 8 to 10 years, but that show has changed. And honestly, I really think that it does. It does cause some of the problems that we're going through, man. I'm not saying that there should be government intervention. I don't want to upset people, but like, if what's the less of two evils here? What's the less of two evils here? Um, it's a horrible thing, man. What are your thoughts on last thing, Luke? This is a final question, okay? And we'll get out of here, man. I have work to do. Oh my gosh, I wasn't supposed to be doing a long live, but my question is can you just talk in, Luke, to the viewers that are on the sidelines, that are frustrated, other than what we've covered in this video? Can you maybe send them some encouragement, maybe explain to them perhaps what they should be doing if they are on the sideline waiting for prices to come down, on affordability to be better? Can you speak some life to people?
Yeah, yeah. I mean, totally. Don't get too wrapped up in this, and make sure that you take your mind off this, and make sure that you look after your mental health, because that is the most key thing. Just don't get too much in your emotions either. Like most people, 90% of people are in their emotions when it comes to investing, when they make a financial decision. It's it's not based on, okay, I have enough income, this is the right time to buy, financially we're in a good place right now. It's usually, I've had a kid, we've just got married. It's something to do with their emotions, the reason why they want to buy. And just don't be one of those people. Make sure it's when it makes financial sense. Does it make financial sense to buy right before a recession? Has the yield curve ever been wrong? No. So I would be happy waiting, and just realize that you have some good opportunities out there right now to go and invest your cash if you have a surplus of cash and get a good return. In my opinion, there hasn't been a better time for the past 15 years that you could go and get a return of over 5%. I mean, 1 year T-bills were at like 5.47 yesterday or something like that. That is a good rate of return. And don't get me wrong, I know inflation is higher than that, but still it's better than nothing, and you're getting paid something to wait. It's better than buying a house right now. I mean, the way that you have to sort of think about it to trick your mind is just imagine that if you have a lot of FOMO, just imagine that you buy and then a recession hits and then the home price drops 20%. How would you feel then? And if you would feel much worse than you do right now with the FOMO, then you know that it's a real bad decision to go buy. And I think most people know this, and that's why they come and watch channels like yours, Travis. So I think we just have to remain cool. We just have to look after ourselves, look after one another. And that's why it's great to have communities like Travis where you can speak to other people and he brings up comments from you guys and definitely talks to you, and it's a proper community. And that's what you want, because you want to speak to like-minded people and see what's going on, but just don't go down the rabbit hole of watching too much content and getting too wrapped up in this. And things will eventually get better. But right now, it's just a case of waiting, and whatever you do to wait, exercise is one of the best things for mental health, and that has been proven time and time again. Go burn off some of that stress, go for a run, go for a bike ride, whatever it is. And we all feel it too. I feel it. I mean, I'm not looking at buying in markets like I am looking at some places in the US, but I'm not looking at buying in particularly Canada. But even sometimes I feel through my viewers what is going on, and I'm like, damn, like I wish things would get better for them. And I get wrapped up in their emotions even as well, feeling bad for them, because I'm just like, man. And even that translates, like I was just in Panama and the housing market there was like just really, really slow, and there was no FOMO, but I had a little bit of FOMO still there. I was like, man, I should buy. I really want to buy. I can afford to buy. I can just buy cash right now. I really want to go do it. And I'm just like, you have to wait. You have to wait until this yield curve plays out and see what happens. Because if you lose your job, if so many different things can go wrong, right? So I feel you guys. And I hope my short rambling there kind of helped, but I doubt it.
It helps me. But I mean, people don't know what they don't know, but thank God that some of them are at least trying to figure out what's going on. And I really love what you were saying about, like, hey, we have a huge opportunity to take the money that we've saved and get money on that with like T-bills and like high yields and things like that. Take a look at this though. Someone commented, let me see if the rates have updated yet. I just wanted to see. Nah, it's still not updated. Take a look at this, Luke. So since we've been on, the 10-year has gone up. Someone made a comment on that. Las Vegas did. So the 10-year is actually up almost 5 basis points right now. So we're back at 3.9. Really amazing what's going on with the 10-year right now, wouldn't you say?
Wow, yeah, there's just been an insane amount of volatility because of the banking crisis that happened. You even saw the yield curve begin to uninvert when that happens, which typically happens around the crash, right before the crash, or during the recession is actually when the yield curve uninverts. I think you have that chart up there with the 10-year, 2-year. If you look at most of when the recessions actually were, you can see that it uninverts just as going into a recession or before it. So, yeah, I mean, the banking crisis, this is the other thing we can't ignore, guys. The banking crisis that just happened, the biggest financial collapses in the United States history, and we're going to believe that everything is okay. We cannot be fooled into that mentality by the mainstream media. I mean, the banking crisis was of epic proportions, and it wasn't just the United States. It affected global bond markets. Credit Suisse collapsed in an entirely different country. This was not just a regional bank thing in the United States. And I know it's very difficult in the United States. I have a lot of family in the United States to look outwards of the United States because the media is very polarizing, and there's so much going on in the US. The US is such a big economy that it's hard to look out. But, you had Credit Suisse collapse. You had global bond markets just absolutely decline in terms of the yields. So that's not a good sign. And basically, that's only going to get worse with quantitative tightening, with the rates going up from then onwards. it's not going to get better. It's going to get worse.
Well, that's what history says,
Hmm.
right? That's what things have always said. Like, and I hear, the bullish arguments, Luke, and it's just like, there's some merit to what people are saying, on the bullish side, but I constantly roll my eyes when they say, oh, it's so strong. This is because it's all propped up. The whole thing was propped up. It's just like when they need to prop up more, they prop up more in certain areas. They do, certain areas they don't. It's all fake. It's all debt. We don't even own anything. I mean, the property taxes. I mean, look at the property taxes. Even someone on a fixed income that owns their house, if their property taxes shoot up $2,000 a year, that may kill them. As far as a cash flow, right? So a
Yeah.
lot of stuff going on here, man. Really important to understand that. Obviously, things are confusing. I think things are just so confusing because of the COVID and the money printing. And if it wasn't for that, it'd be a lot easier to see what's
Yeah.
going on. But I certainly, from the bottom of my heart, man, I appreciate you taking your time to visit with us this morning when you didn't have to do that. I think,
No
a few
problem.
people said they're
Anytime.
going to subscribe to you, man. So let me just throw
Thank
that up
you.
again. You guys go to Market Mania. Here's Luke right here. Luke is a friend. He's in our group chat with some other content creators. Very, very sharp, very genuine person, or I wouldn't even be talking to him. So definitely appreciate you, man.
Thank
I'm going
you.
to get out of here. Any final words, brother? I'll let you go ahead and end this episode with whatever you want to say, but just don't swear.
Patience. That is the
Patience.
key here. That's it.
I love it. All right, guys. So we're going to end on patience. Luke, sit with me here a minute, man. And you guys, if you're out there investing in real estate, both of us wish you luck, and we both hope that you win. And thank